When people ask me how we built Berkshire, they expect me to say we found some secret formula hidden in a vault. But the truth is the real secret behind our success has been insurance. And I'll tell you why in the simplest way I can. People often ask me what really made the difference in building the company over the years. They expect some fancy strategy or a breakthrough idea that nobody else had. But the truth is far simpler. The foundation, the backbone that kept everything else standing strong has been insurance. Without it, we wouldn't have had the resources to buy the businesses we did or to invest in the way that we have. It may not sound exciting at a dinner party, but if you look closely, you'll see that the quiet power of this business has done more for us than almost anything else. The interesting thing about insurance is how it flips the usual flow of money. In most businesses, you put in money first and hope to get it back later with some profit on top. In insurance, people hand you the money first. They pay premiums today, and in return, you promise to take care of them if something happens tomorrow. Now, those claims may not show up for months, years, or even decades, depending on the type of insurance. Until that moment arrives, you're holding their money. And that money, what we call float, is the engine that powers everything else. Float by itself doesn't do the magic. What matters is what you do with it. If you treat it recklessly, if you think of it as a free gift, you'll get into trouble quickly. But if you treat it like borrowed money that you must always be prepared to return, then it becomes one of the most powerful financial tools you can ever have. While it sits with you, you can invest it. You can buy companies, you can purchase stocks, you can let compounding work for year after year. That's what we've done. Every dollar of float has been invested with the mindset that someday it might have to go back out the door to pay a claim. So the investments had to be smart, safe, and long-term oriented. What makes this even more powerful is that float renews itself. People keep paying their premiums. As long as you run the insurance business well, you don't lose that source of funds. It's like a river that keeps flowing as long as you protect its source. That continuous stream allowed us to make investments in businesses like railroads, utilities, consumer companies, and stocks that most people thought we could never afford. And yet, we could because we had this permanent flow of capital at our disposal. But it would be a mistake to think this works without discipline. Insurance is not about chasing growth at any cost. In fact, that's the fastest way to blow yourself up. If you write policies without thinking about the true risk, the claims will eventually come in and wipe away your capital. The hard part in this business is saying no when the numbers don't make sense. You might see your competitors racing ahead, grabbing market share, writing policies left and right, and in the short run they look smarter, but sooner or later the bill comes due. The claims show up, the losses mount, and all the float they bragged about turns out to be expensive capital. We never wanted to win that kind of race. We preferred to grow slowly, carefully, making sure the odds were in our favor. Patience is another piece of the puzzle. The results of insurance don't reveal themselves overnight. You don't get applause in year 1 for the float you've collected. You get rewarded in year 10, year 20 when that float has been invested again and again, compounding quietly in the background. It's not flashy, but compounding never is. You wake up one morning and realize that the stream has become a river and the river has become an ocean. That's how insurance helped us build something lasting. Of course, none of this works without trust. At the end of the day, people buy insurance because they believe you'll be there when they need you most. They're not paying for a product they'll use every day. They're paying for a promise. If you ever fail on that promise, you've lost more than money. You've lost your reputation. That's why we've always treated claims as sacred. When someone comes to collect, you don't argue, you don't delay, you don't hide behind fine print. You pay fairly and you pay promptly. That's how you keep the trust alive. And trust is what keeps the float flowing. So when I look back, it's not the stock picks or the big deals that made the real difference. Those were outcomes, not causes. The cause, the backbone, was insurance. It gave us the capital. It demanded discipline. It forced patience. And it reminded us every day that business ultimately runs on trust. That combination has been worth more than any so-called secret I could have ever shared. Most people hear the word float and think of a parade or maybe a raft on a lake. In business, though, it means something quite different. And I'd argue it's one of the most powerful financial concepts you'll ever come across. The beauty of it lies in its simplicity, and yet very few people ever use it to its full potential. If you understand it and if you handle it carefully, it can transform the way a company grows. That's what it did for us. Here's the basic idea. In most businesses, you put up the money first. You build the factory, you buy the inventory, you pay the employees, and then you wait for customers to come through the door. If they don't, you're in trouble. In insurance, the process is flipped. People give you their money first. They hand you premiums today in exchange for a promise that if something bad happens tomorrow, you'll be there to cover it. Until that day comes, if it comes, you're holding that money that's float. Now, holding money that isn't technically yours is both a responsibility and an opportunity. It's a responsibility because one day some portion of it is going to have to go back out the door in the form of claims. If you spend it foolishly or gamble it away, you'll be sunk when the bill comes due. But it's an opportunity because while it's in your possession, you can put it to work. You can invest it. You can buy productive assets. You can compound it. And that's where the magic happens. Let's say someone hands you $1 billion in premiums. Based on the math of insurance that you might only have to pay out $500 million over time. The rest will be profit if your underwriting is disciplined. But in the meantime, you're holding the full $1 billion. That's a lot of capital you didn't have to borrow. You didn't have to raise from shareholders. And you didn't have to dig out of your own pocket. It's money that came to you because people trusted you to make good on a promise in the future. The great thing about float is that it's not a one-time event. As long as people keep renewing their policies and new customers keep coming in, the stream keeps flowing. You pay out old claims, but new premiums take their place. It's like having a revolving fund that never quite runs dry. The bigger your insurance operation, the bigger the float, and the bigger the float, the more you can invest. Over time, it builds on itself, compounding in ways that can look almost miraculous when you glance back 20 or 30 years. Of course, this magic only works if you respect it. Float is not a free lunch. If you underwrite poorly, if you price your policies without discipline, you can lose more in claims than you ever gained from holding the money. In that case, float becomes very expensive capital. But if you're careful, if you only write the policies where the odds are in your favor, then float can be almost costless or even profitable in its own right. Imagine having capital that not only doesn't cost you interest, but actually earns you money while you hold it. That's when float becomes truly magical. It also demands patience. The rewards don't show up immediately. You don't take in premiums one day and turn them into fortunes the next. You invest carefully. You let compound and do the heavy lifting, and you wait. The world is full of people who want quick wins. But float teaches you the opposite. It rewards the ones who can sit still while the tide rises slowly. Over decades, those who wait find themselves standing on ground much higher than they ever imagined. Another thing I love about float is how quiet it is. It doesn't make headlines. It doesn't dazzle people at cocktail parties. Most folks would rather hear about a hot stock or a flashy tech company. But float is steady, dependable, always working in the background. And when you check the scoreboard after a few decades, you realize that the quiet compounding of float has beaten most of the flashy ideas that came and went. The real magic then isn't that float exists. It's that it gives you time and capital together. Time because you don't have to pay out everything immediately. Capital because you get to hold large sums you didn't have to earn in the conventional way. Combine time and capital with discipline, and you have a formula that's tough to beat. So when I think about float, I don't see a technical term or a line item on a balance sheet. I see a river of opportunity, one that can power an entire enterprise if managed with care. And I see the lesson that's been true in every corner of business. If you respect the fundamentals, keep your discipline, and let time do its work. You'll be amazed at what a simple idea can become. If there's one word that separates the winners from the losers in insurance, it's discipline. The business might look simple from the outside. People pay premiums, you pay claims, and you keep what's left. But the hard part isn't collecting the premiums. It's making sure the policies you write actually make sense in the long run. That's where discipline comes in. Without it, float becomes a liability instead of an asset, and all the so-called magic disappears. You see, anybody can grow an insurance business in the short term. All you have to do is lower your prices and write more policies. Customers love it because they're paying less. Salespeople love it because they're writing more business. For a while, the numbers look terrific. Premiums are pouring in. The float looks big and it feels like you're winning. But underneath, if you haven't priced the risk correctly, you've built a time bomb. It may not go off right away. Claims take time to show up. But when they do, you realize you are writing dollar bills for 90. That's not a business, it's charity. The discipline is in saying no when the deal doesn't make sense. And believe me, saying no isn't easy. Competitors might be grabbing market share. Agents might be pushing for more growth. The board might be cheering higher premiums written. It takes a lot of backbone to say, we're not going to write that policy because the odds aren't in our favor. But in this business, survival is more important than growth. If you forget that, the market will remind you in a very painful way. Think about it like gambling. If you go to Las Vegas and play games where the house has the edge, the longer you play, the more certain it is you'll lose. In insurance, if you price your policies without discipline, you become the gambler instead of the house. You may get lucky for a while, but luck runs out. Discipline flips the odds back in your favor. You don't write a policy unless you're certain the premium covers the risk plus a margin. You don't chase volume, you chase value. That's what keeps you standing when others stumble. Another part of discipline is patience. There are times when the market gets soft. Competitors are cutting prices to win business, and it feels like you're missing out. That's when discipline matters most. You can either join the crowd and write business that doesn't make sense, or you can sit tight, let the foolishness burn itself out, and be ready to pick up the pieces later. We've always preferred the second option. I'd rather go a year writing less business than spend 10 years cleaning up the mess from writing bad business. There's also a human side to discipline. It requires culture. You can't just tell your underwriters, be disciplined. You have to create an environment where they're rewarded for walking away from bad deals, not just for bringing in volume. If people believe their job depends on hitting growth targets, they'll find a way to hit them, even if it means cutting corners. But if they know their job depends on writing good business, they'll think twice before taking on risk that doesn't make sense. Culture, more than any rule book, keeps discipline alive. One of the things I've always admired about great insurance operators is their ability to think long-term. They don't get distracted by quarterly earnings. They don't get pressured by what the guy down the street is charging. They look at risk the way a mathematician looks at probability. They price it, they respect it, and they never kid themselves about it. That mindset is what allows you to sleep at night, even when others are scrambling. The beauty of discipline is that it doesn't just protect you from disaster. It positions you to take advantage of opportunity. When the competitors who cut corners finally get wiped out, customers still need insurance. They turn to the company that stayed strong, the one that kept its promises, the one that didn't chase quick wins. Suddenly, the disciplined player has more business than ever, and it's the right kind of business. That's the reward for staying true when it would have been easy to give in. In the end, discipline in underwriting isn't glamorous. It doesn't make headlines. Nobody writes articles about the policies you didn't write. But over time, it's the quiet refusals, the careful choices, the patient restraint that make all the difference. It's the reason some companies build lasting empires while others flame out after a burst of reckless growth. So, when I think about what really matters in insurance, it's not clever marketing or aggressive expansion. It's the willingness to walk away from bad bets, no matter how tempting they look. It's the patience to wait for the right opportunities. And it's the understanding that saying no is sometimes the most profitable decision you'll ever make. If there is one trait that has served me better than almost anything else in business, it's patience. Most people don't like to hear that because patience sounds boring. They want action, excitement, something that gives them a story to tell. But in business and investing, excitement is usually the enemy of results. The real gains come quietly, slowly from the willingness to wait, while compounding does the heavy lifting. When you think about how wealth is built, it's never the quick flips that matter. It's the snowball effect. You start small, you keep rolling, and if you're patient, the snowball becomes something enormous. But here's the catch. Most people never let the snowball get big because they keep interrupting it. They want to push it down one hill today, another hill tomorrow, and they never let compounding work. Patience is about letting time do what time does best, multiply. In insurance and investing, in any business really, the long-term view is the difference between building something lasting and chasing something fleeting. Take float, for example. The real benefits don't show up in the first year. In the first year, you're just holding money. But after 10, 20, 30 years of investing that float with discipline, you suddenly look back and realize you've built an engine that's far more powerful than you imagined. Most people give up before they get to that stage because they can't stand waiting. There's a story I like to tell. Imagine you could pick any tree in the world to plant in your backyard. If you wanted shade tomorrow, you might pick a fast-growing tree. But in 20 years, that tree might be weak, brittle, and falling apart. If you pick the oak instead, you won't get shade tomorrow, maybe not even in 5 years. But decades later, you'll have something strong, reliable, and lasting. Business works the same way. The ones who think only about tomorrows should rarely build anything that lasts. The ones who think about the oak, those are the ones who enjoy it for a lifetime. Patience doesn't mean inactivity. It doesn't mean you just sit and do nothing. It means you prepare, you invest, you build, and then you wait without constantly second-guessing yourself. You let time be your ally instead of your enemy. The stock market, for instance, is designed to transfer money from the impatient to the patient. The impatient jump in and out, always looking for the next thing, while the patient sit with businesses that keep generating cash year after year, decade after decade. It looks dull, but dull is often where the money is made. Another thing about patience is that it helps you avoid mistakes. When you feel like you must act all the time, you end up doing things you'll regret. You buy businesses you don't understand, you sell too soon, or you overpay just because you couldn't wait. If you can train yourself to wait for the fat pitch, the opportunity that really makes sense, you'll find you don't have to swing very often to end up ahead. It's not about activity, it's about selectivity. And selectivity requires patience. Long-term thinking also gives you clarity. If you're only focused on what the next quarter looks like, you'll make short-sighted decisions. You'll cut costs that shouldn't be cut. You'll write policies that shouldn't be written, or you'll abandon strategies that need time to develop. But if your horizon stretches out 20 years, you're less tempted to compromise. You make decisions based on durability, not on immediacy. That's how real value gets created. People sometimes ask me what the secret to success is, and they're usually hoping for a trick. There's no trick. It's patience and discipline applied consistently. The world will always tempt you with shortcuts. There will always be someone promising you quicker, easier, faster, and once in a while, they might even look smart in the short run. But over time, shortcuts rarely lead anywhere worth going. What patience really gives you is freedom. You're not reacting to every headline, every market move, every competitor's action. You're charting your own course and letting others burn themselves out with constant motion. You're building steadily, quietly, with the confidence that time is on your side. So if I had to sum it up, I'd say patience and a long-term view are less about doing something extraordinary and more about resisting the urge to do something foolish. It's about understanding that big results are the product of small, smart actions repeated consistently over decades. It's about trusting the process even when the rewards don't show up right away. In the end, time is the friend of the patient and the enemy of the restless. When people think about insurance, they often picture balance sheets, actuarial tables, loss ratios, and all sorts of complicated math. And yes, numbers are a big part of it. You have to calculate risk, you have to price it correctly, and you have to make sure the business makes sense on paper. But the truth is, numbers alone don't make an insurance company work. The real foundation is trust. Without that, the numbers are meaningless. Think about what happens when someone buys a policy. They hand you money today, not because they want anything right now, but because they believe that if something bad happens years down the road, you'll be there to help. They can't test the product. They can't take it home and try it out like a car or a new phone. They're buying nothing more than a promise. And promises are only as good as the person or company making them. That's why trust is everything. Over the years, I've seen companies forget this simple truth. They get so focused on chasing growth or cutting costs that they forget the business only exists because people believe in them. The moment customers start doubting whether a claim will be paid fairly, the whole model begins to crack. Once trust is broken, no amount of clever marketing or attractive pricing will save you. People may buy from you once, but they won't stay. Insurance is one of those businesses where reputation compounds. If you build it carefully over decades, it becomes your greatest asset. If you damage it, you may never recover. That's why whenever a claim comes in, we treat it with the seriousness it deserves. Nobody files a claim because they're having a good day. Something has gone wrong in their life, sometimes something tragic, and they're counting on you to stand behind your word. If you respond with delays, excuses, or fine print, you've not only failed a customer, you've planted a seed of doubt in every other customer who hears about it. But if you respond fairly, promptly, and with respect, you strengthen the bond that keeps the business alive. Trust also plays a role inside the company. Underwriters, agents, managers, they all have to trust that the culture rewards honesty and discipline, not shortcuts. If people inside the business are pressured to grow at any cost, eventually corners will be cut. And when corners are cut, customers notice. The culture has to make it clear. We don't just want more policies, we want the right kind of policies. And we want to treat people honorably when the time comes. That culture doesn't show up in a quarterly report, but it shows up in the long run when customers keep renewing year after year. It's easy to underestimate how fragile trust is. You can spend 50 years building a reputation and lose it in 5 minutes by acting the wrong way. That's why we've always emphasized doing the right thing, even when it costs money in the short term. Paying a claim you technically might not owe, but that you know is the fair thing to do, can feel painful in the moment, but it's a cheap price compared to the value of trust. Customers talk, word spreads, and over time, people learn who keeps their word and who doesn't. Another interesting thing about trust is that it turns the float into something much stronger. Remember, the float exists because people give you money today believing you'll be there in the future. If they don't trust you, the float dries up. If they do, it grows and grows. Every dollar of float is at its core a reflection of how much people believe in your ability to keep a promise. That means every investment we've ever made with float, every company we've bought, every stock we've held has been built on the foundation of trust. Without it, none of it would exist. When I look back at the insurance business, I don't just see numbers on a page. I see millions of people who put their faith in us, who believed we'd be there when they needed us most. That's a responsibility you can't take lightly. You don't build that kind of relationship overnight, and you don't keep it by being clever. You keep it by being consistent, by being honest, and by making sure that when the time comes, your promises mean something. So yes, the math matters. You can't run an insurance business without good actuarial tables and sound pricing. But the math is the easy part. The hard part, the part that really decides whether you'll succeed or fail, is whether people trust you. Numbers may get people in the door, but trust keeps them there. And in the long run, that trust is worth more than any spreadsheet could ever show. So the secret behind our insurance business isn't really a secret at all. It's float, discipline, patience, and trust. Simple ideas, but very few stick to them. And that's why it works.